Okay, let's get started. As we know, Wall Street can be a complicated place. It's full of products that could confuse the expert of experts, like the $6.2 billion London whale trading loss that took place at JP Morgan in 2012. Many of these complicated investment products are incompatible for retail investors. Even so, that doesn't mean stocks and bonds would be our only options. One of the hardest challenges we face as investors is to find the right set of financial products that meet our needs. So in the next couple of videos, our goal would be to explore the main types of investment products offered by the asset management industry. And, by the end of the topic, we will figure out which investment option is best for each of us. Alright, there are 6 types of investment products we will examine: mutual funds, separately managed accounts, exchange-traded funds, or ETFs for short, hedge funds, private equity or buyout funds, and venture capital funds. Without further ado, we'll begin with mutual funds. Basically, mutual funds represent a pool of money collected from a multitude of investors. A professional portfolio manager then invests the capital into a portfolio of securities. When the fund generates returns, the gains are passed down to the investors on a pro-rata basis. Investing in a mutual fund is different from obtaining a stock. It's like buying the performance of a portfolio, or, more precisely, a part of the portfolio's value. Unlike stocks, mutual fund shares do not grant any voting rights to their holders. Instead, they represent an investment in many different stocks instead of just one holding. The mutual fund's share price is called the net asset value, NAV, per share. It is measured daily and represents the total value of portfolio assets minus liabilities divided by the number of outstanding shares. For example, let's say a mutual fund has $65 million invested in securities and $5 million in cash for a total of $70 million in assets, whereas the fund's liabilities are $20 million. As a result, the net asset value would be $50 million. If the fund has 5 million shares outstanding, the net asset value per share would be $50 million divided by 5 million shares, or $10 per share. Perfect! Next, let's consider the mutual fund structure. A mutual fund can be set up as an open or closed-end fund. Open-ended mutual funds do not limit the number of shares offered. Such structures accept fresh capital by issuing new shares at the net asset value. The fund's portfolio manager then uses the cash to acquire more securities. The opposite is also a situation that could occur. Open-end funds buy back existing shares at the net asset value per share. It is this ease of entry and exit that makes it a convenient vehicle for investors, those looking for an investment opportunity while maintaining their liquidity at the same time. In contrast, closed-end funds issue a limited number of shares only once and through an IPO. After all the shares are sold, the offering is closed, hence the name. No new investment capital can flow into the fund. Closed-end funds do not repurchase shares from investors. Instead, clients can sell them on the open market just like they do with ordinary securities. One of the unique features of closed-end funds is pricing. While the fund's net asset value is calculated regularly, its price on the exchange is determined based on supply and demand. Therefore, a fund could trade at a premium with the price above the net asset value or a discount to its NAV when it is below the NAV. Okay, as you may have figured, both types of mutual funds come with their set of advantages and disadvantages. Open-end mutual funds can easily grow in size, offering liquidity to investors who can buy and sell their shares at net asset value. At the same time, additional cash flows from the issuance and redeeming shares may create pressure on the portfolio manager. Cash inflows require finding new investment opportunities, while stock redemptions drive portfolio managers to maintain adequate cash reserves. If too many shares are sold in one go, the fund will need to sell some of its assets to pay the investors. To avoid this scenario, open-end funds always keep sufficient cash levels for redemptions. Of course, this creates an opportunity cost by not using the total fund capital. By contrast, closed-end funds do not face the same issue with cash flow volatility. These funds don't redeem shares, and therefore don't need to maintain large cash reserves. This leaves them with more capital to invest. Closed-end funds also use leverage to increase returns, which is why they realize higher returns than their open-end counterparts. Regardless, there are some disadvantages to closed-end funds. Firstly, they have a limited ability to grow as the number of shares issued is fixed. This feature makes them less liquid than the open-end funds. As mentioned before, a closed-end fund's price is determined by supply and demand market forces. For this reason, it is possible for the fund to trade at discount, below the NAV. Moreover, the fund's use of leverage makes the share price volatile and unsuitable for all investors. At this point, you must be wondering which of the two structures is more popular. Well, we'd like to bring to your attention a fact. Of the total net asset value of all U.S. mutual funds, only 1% are in the form of closed-end funds. I believe this pretty much answers the question. Well then, that was one way to differentiate between mutual funds. But there exists another method as well. Like most things in life, there are costs and commissions, and mutual funds are no exception. Portfolio managers charge a fee for the ongoing management of the portfolio assets. Often, it's a percentage of the fund's net asset value, usually no more than 1.5%. Nonetheless, some mutual funds could charge a sales fee, known as load, when investors purchase or redeem their shares. Conversely, the funds that don't have such a fee are called no-loads. The sales commission could be a percentage of the amount you invest or a flat fee, depending on the mutual fund provider. Say you put $1,000 into a 6% load mutual fund. In this situation, you would actually invest only $940, with the remaining $60 going to the fund as a commission. Load funds are usually sold through retail brokers who also receive part of the upfront fee. On the other hand, no-load funds are bereft of a fee for investing or redemption. We must be careful when buying them. A fund can market itself as no-load and still try to make it up by charging other hidden fees. So, which is the best way to determine expenses? Read the fund's prospectus carefully. Alright, we've come a long way. However, we could still do a bit more by delving into the different mutual fund types that exist in the marketplace. Depending on asset class that they invest in, there are 4 types of mutual funds: money market funds, bond mutual funds, stock mutual funds, and balanced or hybrid funds. Money market funds invest in short-term debt securities like commercial paper, treasury bills, and certificates of deposit. They are considered one of the safest investments and account for 15% of the mutual fund market. Such funds have 3 important goals: to provide security of principal, obtain high liquidity, and achieve returns close to money market rates. Most of money market funds operate on a constant net asset value basis, often aiming at $1 per share. That's one of the primary reasons for their popularity. The constant net asset value basis forces fund managers to make regular payments to investors, providing them with a regular flow of income. In most cases, investors use money market funds as a place to park money temporarily before investing elsewhere. This is because they generate little capital appreciation, making them impractical for long-term investments. Excellent! Bond mutual funds invest in fixed income securities too. The key distinction between bond and money market mutual funds is the maturity of the underlying assets. The former holds fixed income securities with maturities of up to 30 years. By contrast, the money market fund's maturity rarely goes beyond 90 days. Up next, we have equity mutual funds, which invest primarily in stocks. These funds can be further classified as active and passive. The goal of actively managed mutual funds is to outperform a benchmark index by taking a hands-on approach and selecting individual securities. Conversely, passive funds match the performance of a particular index, such as the S&P 500. Active funds charge high management fees. After all, they do require extensive research from a team of analysts who examine qualitative and quantitative factors. In addition, these funds realize a higher portfolio turnover, the percentage of investments bought or sold during the year. As a result, actively managed funds incur more transaction costs in the process. The more frequent purchase and sale of assets leads to realization of capital gains. This is why actively managed mutual funds pay a substantial amount of taxes. Alright, before we wrap up this session, we should look at one last type of mutual funds called hybrid or balanced mutual funds. The objective of these is a balance between growth and income, hence the name. They invest in a mix of stocks and bonds. Life cycle or target date funds are the most popular examples of this category. Target date funds are a popular investment vehicle for investors who want to plan their retirement. Each life cycle fund defines its time horizon by its name. For example, let's say that the current year is 2025. If we buy a 2095 target fund, the time horizon would be 70 years. Life cycle funds are based on the idea that young investors can handle more risk. Thus, the asset class mix is automatically adjusted with time. In other words, as maturity date approaches, the percentage of bonds and other low-risk investments will increase in a proportional manner. A quick example will illustrate this better. Suppose it's 2025 and you invest your capital in a life cycle fund with the target date of 2065. Initially, the fund will be aggressive. In 2025, it will probably hold 80% stocks and 20% bonds. Yet each year there will be more bonds and fewer stocks in the fund. By 2045, when you're halfway to retirement, the fund would consist of 60% stocks and 40% bonds, or 50% stocks and 50% bonds, and so on. Finally, it would be much more conservative in terms of expected volatility. For example, 30% stocks and 70% bonds by the target retirement date of 2065. Fantastic! In our next video, we will discuss some of the other investment products offered by asset managers. This will do for now. Thanks for watching.